There is a 3-letter code embedded in the commercial law of all 50 United States that gives you the legal right to demand something your credit card company prays you never ask for. The original contract, not a printout, not a screenshot, not a statement generated by a computer. The actual, original, signed agreement that proves you owe what they say you owe. And if they cannot produce it, which in millions of cases they cannot, the debt may be legally unenforceable. This is not a conspiracy theory. This is Article 3 of the Uniform Commercial Code, the foundational legal framework that governs every commercial transaction in America. And it has been on the books since 1952. The credit card industry in the United States generates over $105 billion a year in interest charges alone, according to the Consumer Financial Protection Bureau. Total credit card debt in America crossed $1.14 trillion in 2024. The average American household carrying a balance owes approximately $8,000, and the entire system depends on one assumption that most consumers never question, that the entity demanding payment can actually prove the debt is valid. What if they cannot? What happens when you send one letter citing one law and the foundation cracks? Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. Let me take you back to where commercial law began. The Uniform Commercial Code was first published in 1952, the product of a collaboration between the American Law Institute and the National Conference of Commissioners on Uniform State Laws, now known as the Uniform Law Commission. Its purpose was to harmonize the patchwork of commercial laws across the states, creating a uniform framework for the sale of goods, leases, negotiable instruments, bank deposits, letters of credit, and secured transactions. Every state except Louisiana, which uses a civil law system, has adopted the UCC in substantially similar form. Louisiana has adopted most of its articles as well. Article 3 of the UCC governs negotiable instruments, which include promissory notes, checks, and drafts. But the principles within Article 3 extend to any commercial obligation where a party claims the right to collect payment. Under UCC Section 3301, a person entitled to enforce an instrument must be the holder of the instrument, or a non-holder in possession who has the rights of a holder, or a person not in possession who is entitled to enforce under certain loss or destruction provisions. The critical phrase is holder of the instrument. To be a holder, you must possess the original instrument with all necessary endorsements. Now here is where the credit card industry's infrastructure creates a vulnerability. When you signed your original credit card agreement, whether at a bank branch, on a paper application, or through a digital enrollment, that agreement became a contract. If you defaulted and the debt was charged off, the original creditor, the bank, typically sold your debt to a third-party debt buyer. The debt buying industry is enormous. According to a 2013 Federal Trade Commission report titled The Structure and Practices of the Debt Buying Industry, the 9 largest debt buyers purchased over $200 billion in face value debt over a 3-year period, paying an average of 4 cents on the dollar. That means a debt buyer purchased your $8,000 balance for approximately $320. When the debt was sold, the original paperwork often did not transfer with it. The FTC's own report found that debt buyers received the original signed contract in only 35% of purchased accounts. In some portfolios, the figure was far lower. The buyer received a spreadsheet with a name, a social security number, and a balance. No contract, no signed agreement, no original instrument. And yet they began collection efforts immediately, calling, sending letters, filing lawsuits, and reporting to credit bureaus as if they held the proof. This is where the UCC intersects with another federal law, the Fair Debt Collection Practices Act, specifically Section 809, which is codified as 15 USC Section 1692G. Under FDCPA Section 809B, if a consumer disputes a debt in writing within 30 days of receiving the initial collection notice, the debt collector must cease collection efforts until it provides verification of the debt. The word verification has been interpreted by courts with varying degrees of strictness, but the underlying principle is clear. You have the right to demand proof, and the collector has the obligation to provide it before continuing. The strategy that has emerged from the intersection of UCC Article 3 and FDCPA Section 809 is straightforward. When a debt collector contacts you, you respond in writing within 30 days with a debt validation letter. This letter states that you dispute the debt and request the following. First, the original signed contract or credit agreement. Second, a complete accounting of the amount claimed, including all fees, interest, and charges. Third, proof that the collecting entity has legal standing to collect, meaning documentation, showing the chain of assignment from the original creditor to the current holder. Fourth, proof that the debt is within the applicable statute of limitations for your state. If the collector cannot provide these items, they are prohibited from continuing collection under the FDCPA. If they report the debt to credit bureaus without verification, they may be in violation of the Fair Credit Reporting Act, specifically 15 USC Section 1681(2), which requires furnishers of information to report accurately. If they file a lawsuit without the ability to produce the original contract, they may lack standing, and you can challenge the lawsuit on that basis. Before I go further, this video is just the surface. Inside the invisible ledger vault, you will find professionally drafted debt validation letter templates, a state-by-state statute of limitations chart, a guide to responding to debt collection lawsuits, and the specific UCC and FDCPA sections annotated in plain language. The link is in the description. But stay right here. The court system has addressed these issues extensively. In Spears v. Brennan, a 2014 case in the 11th Circuit Court of Appeals, the court examined whether a debt buyer had standing to sue when it could not produce the original credit card agreement. The court held that the debt buyer had to demonstrate a valid assignment and the terms of the original agreement. In numerous state court cases, judges have dismissed collection lawsuits when the plaintiff could not produce documentation beyond a spreadsheet purchased from the original creditor. In 2017 and 2019, the Consumer Financial Protection Bureau issued rules clarifying the obligations of debt collectors, including requirements for substantiation before initiating collection. The CFPB's debt collection rule, which took effect in November 2021, requires collectors to provide certain disclosures and makes clear that consumers have the right to dispute and request validation. The debt collection industry generates approximately $13 billion in annual revenue. There are approximately 6,000 active debt collection agencies in the United States, according to IBIS World. They purchase charged-off debts for pennies and pursue the full face value. Their profit model depends entirely on consumers not knowing their rights, not sending letters, not demanding proof, and not showing up in court. According to the National Consumer Law Center, over 70% of debt collection lawsuits result in default judgments, meaning the consumer never responded. They lost not because the debt was valid, but because they never challenged it. If you have made it this far, you already know more about your rights under the UCC and FDCPA than the vast majority of consumers who receive collection calls every day. Subscribe and share this video. Now let me give you the exact steps. Step 1. If a debt collector contacts you by mail, note the date of the letter. You have 30 days from that date to send a written dispute. Step 2. Draft a debt validation letter. State that you dispute the debt in its entirety. Request the original signed agreement, a full accounting of the balance, proof of the collector's legal authority to collect, and confirmation that the debt is within the statute of limitations. Send this letter via certified mail with return receipt requested. This creates a legal record that you sent it and they received it. Step 3. Once the validation letter is sent, the collector must cease all collection activity until they provide a verification. If they call you, inform them that you have sent a written dispute and that all further communication must be in writing. Under the FDCPA, you have the right to demand that collectors communicate only in writing. Step 4. If the collector cannot validate the debt, send a follow-up letter demanding that they remove any reporting from your credit file. Cite the FCRA Section 1681 as 2 and state that reporting an unverified debt is a violation of federal law. Step 5. If the collector files a lawsuit, do not ignore it. Respond. File an answer. In your answer, demand production of the original contract and challenge their standing. In many cases, the collector will dismiss the case rather than proceed without documentation. Step 6. If the collector violates the FDCPA by continuing collection after your dispute without providing validation, you may have the right to sue them. Under 15 U.S.C. Section 1692K, you can recover actual damages, statutory damages of up to $1,000 per violation, and attorney's fees. The total cost of a debt validation letter is the price of certified mail, approximately $7 to $8. The potential benefit ranges from removing thousands of dollars in questionable debt to winning statutory damages in federal court. I need to be honest with you. This is not a magic eraser for all debt. First, debt validation works most effectively against third-party debt buyers who purchased old charged-off accounts. If the original creditor is still collecting, they typically have all the documentation. Second, sending a validation letter does not eliminate a debt that is genuinely owed. If the collector produces the original contract and proper documentation, the debt remains valid and enforceable. Third, the statute of limitations on debt varies by state, from 3 to 10 years, depending on the type of debt and the state. If the statute has expired, the debt may be uncollectible through the courts, but it does not disappear. Fourth, some consumers have been misled by sovereign citizen movements and fraudulent UCC filing schemes that claim you can discharge all debt by filing UCC liens against the government. This is illegal, it does not work, and people have been prosecuted for it. What this video describes is the legitimate, legally established right to demand proof of a debt under established federal and state law. And fifth, this strategy requires action. You must respond in writing, within the deadline, with the correct citations. Doing nothing is exactly what the industry counts on. Your grandparents understood something that the age of instant credit made everyone forget. A debt that cannot be proven is not a debt. It is a claim. For centuries, commercial law required the person demanding payment to produce the instrument, the note, the contract, the proof. Then one generation was taught to accept a phone call and a threatening letter as evidence, to pay without questioning, to fear a credit score more than an unjust demand. There was not a stronger system of collection. There was just a system that trained you to stop asking the one question that matters. Can you prove it? Subscribe and share this video. Every share puts that question back in the hands of someone who needs it. The next vault opens soon. And what is inside will reveal why banks write off billions in debt every year and exactly who profits when that debt is resurrected.